Hello, thanks for inviting me. Nice to meet everyone.
Hi everyone, we'll start in a couple of minutes. Hi everyone, we'll start really soon. Quickly, daylight savings kicked in, so I understand that there was a time confusion for a bunch of people. So sorry if that inconvenienced you in any way. Daylight savings is a pain in the butt for us and for those of us in Australia. But we should start soon. I'll just wait for a couple of more minutes for some more people to join and then we'll kick off. Any questions in the meantime, please feel free to leave in the comments. Okay, I'll kick us off. People will keep joining as we go, which is fine. And there were some people that emailed last minute that they can't make it. So I hope that people in this call are okay with this being recorded, as we'll send the recording out as well. Also, special thanks to one of our amazing panelists, Sharine, who's joining from Morocco. So it is quite early for her. So thank you for making the effort. But thanks to all of our panelists in general for doing this. We're really excited to hop into the topic, to bootstrap or capital raise. But first, quick round introductions. So I'm Alicia. I'm the community builder for Australia. I don't do it alone though. Franco works with me, so I don't know why he just stuck my picture up there. But essentially, we work for REAPRA. So REAPRA is a venture program that's new to the Australian market. We've actually started in Japan. There was a company called SMS, which was created by a man named Shuhei, and he created this fund, which is essentially looking for entrepreneurs to build long-term systemic problems. REAPRA actually stands for research and practice, and consulted academics and psychologists to come up with a framework works to essentially foster entrepreneurs that are building towards long-term solving long-term systemic problems within society, which is super interesting. Very different to anything that I've seen in Australia, certainly, and I've done a few accelerator programs now, one of which is StartMate, which was done by Blackbird. So excited to tell you a bit more about REAPRA, but first, to start off with how today will work is we will have quick round introductions. We'll have the panelists then introduce themselves, and we'll hop straight into each panelist and hearing from them what their opinions are on bootstrapping, so funding your startup and business yourself, versus raising from investors. You'll hear about their experiences, lessons learned, all of the juicy stuff, and then we'll head to some questions from the audience, so you can send those in through the Q&A part of this meeting, and we'll try and get through as many as we can while we have the panelists here, and then we'll close from there. So a bit more about REAPRA. Essentially, what's a bit different, I think, is that instead of you coming along and pitching a business idea, which is very standard for programs or any funding you're trying to seek for your business, you actually just pitch yourself. And the first part of the program is actually, it's called IFD. I call it the self-discovery part of the program, and it actually dives into who you are as a person, and to then find you sort of your life mission, and we then fund you to build a business that aligns with that. That's a bit more information up there on the slide about us, but you can look into us. That's not the point of tonight, though, so I'm going to hop now into the main session. So kicking off with, why did we want to dissect this topic in the first place? I think capital raising and bootstrapping, they're two funding models, right? And when it comes to your business, how you're going to fund your business is a super important element, which can inform so many things: the way you run your business, who you run your business with, what might happen to your business. It's all incredibly pivotal. So it's very important to think about things like, as you're building your business, are you optimizing for growth versus profitability? The difference there, for example, might be Uber as a use case, who in the first place optimized for users. It was just how much money can you spend to get users, and they weren't making money at that point. That's sort of the big difference. Whereas building for profitability is, how can you make sure that the business is self-sustaining from day dot? So you need to be, charging your customers versus offering users free access just to get numbers in and to build that up, to then later turn on that tap and start charging users. Secondly, we want to talk about the challenges and rewards of each of those approaches, because they both have their pros and cons. As with startups and building businesses, as most of you may know already, there is no one approach beats everything. It's all very dependent on a variety of factors, a lot of which include the market, your industry. So there really isn't a template. So it really is an individual decision for yourself. And then how to build a sustainable business. So how can you balance short-term gains with long-term viability so that your business survives? Not just survives, but flourishes. So without further ado, we're going to hop into our panelists, amazing panelists from a variety of backgrounds who've tried a few of the funding approaches in building their businesses. And we'll kick off with, so we've got Ben Wood, who's the co-founder of Whipwork, Emily Price, co-founder of Tallystone, and Sharine, who's a customer success manager, but also founder of Rest Day, and who's also founded another startup as well. So kicking off with Ben. So I'll let Ben introduce himself, and then we'll get into the discussion. Ben, if you could unmute yourself.
I can. Thanks, Alicia. Thanks for the introduction. Hey, everyone. I'm Ben. I co-founded Whipwork, which is Waste in Progress Workshop, with a friend of mine, Frank, just on a year ago. Essentially, we recognize that the technical waste from the outdoor education industry and the outdoor industry as a whole, there was a huge opportunity there to possibly make brand new products. Often tents, backpacks, these materials are perfectly good. They're waterproof, they're strong, but the seams break down over a few years. And so we recognized that there was a lot of challenges with recycling, and that we might be able to use our skills, myself as a product designer and Frank as an engineer and a business major, to possibly create brand new products of an equivalent quality to what you see on the store, in a store made from virgin product or virgin material. And so we have taken on this mission for the last year to deconstruct old tents and backpacks, tell a new story, and make brand new product and learn if that's possible or not. And we actually make and manufacture them all locally. So to kind of tackle those two missions of storytelling to new products and local manufacturing here in Australia.
Amazing. And so Ben, yourself and your co-founder, how did you go about getting the money you needed for your startup?
So we have bootstrapped it. Frank and I were quite intentional about wanting to do this off our own back. We're new to this. It's our first startup, and we had this, and we don't know if it's true. And probably in reality, it has come true in the end, that we didn't know what we should have spent our money on if we had the extra money. So we wanted to start at bare bones and see how much stuff we could essentially buy a Facebook Marketplace, like do it as bare bones as possible. So we knew where the limitations were, and we knew exactly where we should spend the money if we could. And now we've started applying for grants and looking for investments, so we know where we should spend our cash, really.
And did you have people along the way sort of say, why don't you just raise money for it?
Yeah, absolutely. And for us, it was really about control and taking it in the direction we wanted to go. In many ways, we know that the success rate of startups is, for your first time, is quite low. So we wanted to treat it as a learning experience. And so that if we wanted to, Frank and I could divert into spaces we were curious about learning about, and to build our skill set as much as try to create a successful business from the start. As much as we want to make this thing sing and succeed, we wanted to make our mistakes as we went and learn from that, and bring mentors in along the way to kind of guide us. But yeah, so much of it was about our own control and wanting to direct this ourselves.
Yeah, that makes a lot of sense. And also, and also with starting the business, now you're looking at grants, you said. Why are you considering grants as a funding option?
Essentially because there's no strings attached. We've raised enough money now, or we've made enough money essentially, that we can go for those 50-50 grants where you provide as much money as you are offered, and then we can, well, based off our own decision making and our own ideas and research over the last year or so, funnel that into the spaces we want to. For us, a lot of it's about manufacturing, a lot about efficiency and production quality and durability. So that's kind of where we'll end up putting our money, most likely.
Yeah, that makes sense. And was there someone that nudged you in the direction of grants? How did you learn about that you could apply for a grant to fund your business?
That's all Frank's work. So he's been looking at grants from the start, essentially from day dot, and just saving a little list of ones that he thought might be valuable for us. Xero's Big Business Fund is our most recent applicant, and then there's a couple offered, some by eBay and the Australian Fashion Council and things like that. So we were just kept an eye, because we are in a space that the grants are being offered to, shall we say, sustainable textile waste focused industry. So yeah, it's a point of interest.
Yeah, and when you say so, the control is a really important aspect of deciding what funding option you want to pursue. Where do you think that factor is really important? So, for example, for a lot of our audience, a majority of them are potential founders. They're still about to go into their first startup. What would you say is the direction they should head in tossing up whether control is an important aspect for them? Is it to do with the nature of the business? Does it matter that it's that this business, for example, is meant to help society in some way? What about for those that just want to make a lot of money really quickly and want to learn business skills? What kind of factors do you think are important for them to weigh up at this stage?
Yeah, that's a tough question, because I don't know if I have enough experience to give a great answer for this. I'm so new to it myself, but for me, it was about what I wanted to learn. I am a product designer by trade, and I wanted to do something in sustainable textiles or sustainable product development. And in many ways, it's quite hard. So for me, having the mission was, aside from trying to make a living and trying to make money, was to learn a skill that was transferable to any other space that I might go into in the future. And So for me, it was about what I wanted to learn, and that would influence my funding direction or method. I can't give a great answer, but for me, simply put, I want to create value from valueless things. We have so much waste and so much that's thrown out that if I can master that skill of storytelling and creativity, creative problem solving, then I think that's transferable into another startup that I might start, or with somebody else, something like that. So the roundabout way of saying, what would you like from it and what's the fastest way to get there, simply put.
Yeah, no, that's really helpful. And when you say you're looking at grants, but you're also now only just now considering investors, how far have you now got into this venture, and what has made you think, now I think I'll start looking at investors?
Yeah, great question. So we started off making bags because we thought we could make cool stuff for our friends, as many product startups do. And we quickly realized the ego and reality check is that doesn't pay the bills. You know, selling 30, 40 bags a month is not going to pay your mortgage or anything even close. And we essentially, over the last 12 months, have gone through a kind of an expansion and contraction of trying every single product people asked us to make and figuring out what profited the best and what worked the best. And now we have recognized where we can make our impact, and not just money. I mean, how much material can we move on a weekly, monthly, daily basis kind of thing. And we've recognized those areas. A lot of it is in the business to business market. So utilizing those technical materials to create dust covers or other kind of protective equipment, and knowing that the design skill set required and the manufacturing speed all start to line up. And now we start to look for investments so that we can essentially accelerate that as fast as we can to check to see if this is going to be sustainable or not for us in the long term, and whether it meets our needs.
Yeah, that's awesome. And so we've got about a few seconds left to finish you, though there'll be time for some more comments at the end. Ben, with the decision now to, okay, let's start looking at investors, what are you thinking about in terms of who would be a good investor for your business? What elements are you thinking about when you're looking at people for this?
I want to know what their values are first, before I even look at what kind of card or influence they will have over the business. I want to know where their heart is and what they've done beforehand. This business is really precious to Frank and I, and we want to make sure we are all on the same page together. The communication channels there, the openness, the vulnerability, all of the core stuff is there before we take any steps.
That's awesome. Thanks so much, Ben, for your time.
You're welcome.
At the end of Sharine's talk, I've got some time set aside for some top tips from you guys before Q&A. So would love to hear from more then. But thanks so much, Ben.
You're welcome. Thank you.
Now put the next person in the hot seat, I call it. It's not really hot seat. You're chatting a bit. But we've got Emily. So Emily, I'll let you introduce yourself, and then we'll hop into some discussions.
Cool. Awesome. Thanks, Alicia. Hi, everyone. My name is Emily. I'm the co-founder of Tallystone, where we're creating automatic data rooms. So for those of you, where you're first-time founders or looking to start a company, what that essentially means is when you go out and raise capital, what an investor is going to ask you is, cool, we're interested, give me access to your data room. And essentially it's storage of all the documents and data that are relevant to them making a choice as to whether they're going to invest in you or not. Now, normally the process of doing all that, very manual, very time consuming. And so what we've done is created an automated way of doing that, and also help you along the way manage your company in a more efficient and secure way. So that's Tallystone. We're pretty early on in our journey as well. But before starting with this, I was actually a technology and startup lawyer. And so I was advising a lot of startups about going through the capital raising journey. A lot of them also bootstrapping. So I've seen, people going through various different journeys and kind of learn from that. And that's also fed into the product that we're building.
No, it's awesome that where you ended up following what you were working in as a career, and then what you've built now. And you've got two co-founders, don't you, for Tallystone?
Yes, I do. I have a technical co-founder, Lachlan, and our other co-founder is John.
Yeah, amazing. So there's three of you. And is yours bootstrapped, or did you raise capital yet? How have you funded Tallystone so far?
Yeah, it's funny thinking about how you're going to ask this question. it's, even though it's a binary question, the answers sometimes aren't, and I don't think we can fall neatly into either category. I think the purists of bootstrapping will be like, oh no, like you don't fall into that, but we also haven't exactly raised capital. So we are funded by what's called a family, friends, and fools round, which is, you know, people that we knew in our networks, providing some initial, I guess, angel investment. And that's how, and also our own personal funds as well. So it's funding. So it's kind of bootstrapped, but not quite. And I think that's also like an important understanding of when making that decision of bootstrapping. Sometimes people go, oh, we're a bootstrap startup. And you go, okay, but where did those funds come from? And is it, I think it's not all bootstrap startups are equal.
Yeah, no, definitely. But, and what drove that decision to fund your startup that way? Especially
very simple
experience, seeing startups raise all the various ways that you can fundraise.
Yeah, I think similar to what Ben was saying before, which is knowing where to put the money before going out and asking for it. So understanding, you know, what our product is going to look like, getting some initial traction, being able to pivot on what we're actually doing until we find, you know, our ICP and our product market fit and all those buzzwords in startup world. The idea is like, if you go out to capital raise, you have all this money, but money actually doesn't solve all your problems, and often actually confuses you on what is the problem that you need to solve to make this a successful business. So for us, we want to focus on answering those questions initially and getting some traction, and then potentially in future capital raising. I think it's not just like a we will or we won't, it's a journey. And so if we come to a point where we go, okay, this is the next stage of Tallystone and we need this pool of cash to be able to achieve this, we would definitely be open to capital raising then.
Yeah. And with Tallystone, so you've chosen family, friends, and fools first, and then raise investment at a later stage. For people sitting there thinking, I have an idea, but it's going to cost money to build, is it such a no-no to raise capital first rather than bootstrap? What have you seen happen also with other startups? I guess I'm asking, what are the pros and cons to going, you know what, I had this idea, I'm going to raise the money right now. What would be wrong with that?
I don't think there's anything inherently wrong with going, I have an idea and I'm going to raise capital. I think understand, first of all, that puts you in a more like a disadvantaged position and is a bit more difficult than if you had a product for obvious reasons. But the decision of whether or not you go out and raise capital based on an idea is really to do with, you know, kind of what you've already been talking about, which is, you know, control is one thing, exit strategy is another. You know, how long is the lifespan of this business for you? So is it that you're going all the way to an IPO? Is it that in 5 years you want to sell? What is the plan? And then along the way, is your focus more on control and power? Do you want to maintain the biggest amount of control in your company? Or do you want to, you know, even though you'll hold less of the company, you're okay because the company's going to go do this massive hockey stick and you're going to be worth millions or billions of dollars as a company. So understanding like, okay, what's the journey and what's the end point? And is this the right decision to get me to the end point that I want to go to?
With Tallystone, what would you say is when it's time to look for investors, what are you looking for in particular for Tallystone? Or it's okay if you haven't thought much about it, but on the top of your head, who do you think would be the best sort of investors for Tallystone when you're ready to look?
Yeah, I think at that point there will have to be more strategy to it than purely financial. The later the stage that you get to the more money that you're asking for, the involvement of the investor is a bit more. So they want to be a bit more hands-on, and they might want to, you know, sit on your board as well. So if you have the board of directors of your company, that means that they have a vote on kind of the strategic decisions that you make. And that's where Tallystone comes in really handy to manage all those people. But what that means is then you want to make sure that the person that you're inviting inside the house of your company is going to add value other than just money. And so, looking at well, maybe depending on where Tallystone's at, is our focus on we want to expand to new markets. So we want to go to America, and therefore we want an investor who has a presence in America and that can help us go over there. Is it that we're exploring partnerships into a new industry, and so we want someone who has a really strong presence in that industry? It's kind of all of those different factors, and it will depend on where Tallystone's at and what our priority is.
Amazing. Thanks so much, Emily. Same for you. Hot seat's done now, but at the end of Sharine's talk, we're going to do a few more tips and comments from the three of you before we open for some Q&A. But thanks again for introducing yourself. And I already see questions coming in to the comments, and don't worry, we'll get to them. So thanks so much. We'll have Sharine now. I'll just flip you over here, and Sharine will introduce herself.
Hi, everyone.
Hey, so Sharine, I'm going to pin you to the... All right. Shoot. Okay. Who are you, Sharine?
Hello, everyone. I'm Sharine. So my background actually quite similar. I'm in law. So I actually graduated from a Bachelor of Laws and International Relations degree back in 2017. And my first few jobs at the start were very much legal related. So I used to file bankruptcies for customers, personal as well as for company bankruptcies as well. And very soon after not really enjoying my job, as a lot of people probably can relate, I think at that time, I just had an idea of an app that would allow people to be able to see what types of products were available for purchase around their area. So that kind of kickstarted my experience and also my journey as a founder. I remember this was around 2018. I had no idea of what startups were. I didn't even really know what the word founder was. So I kind of fell into the startup and the technology space. And at the time, I had a co-founder, but also a partner who was an engineer. And we also had some friends who were in the marketing space. So we kind of just built this startup off just people that we knew in the area, because at the time, startups weren't so popular, especially from the area like in the Gold Coast where we were actually in. So we kind of just like came together and built this startup. And at the time we had raised some angel investment. So I think what Emily also mentioned, we never got to the institutional investment side of things, but we had raised some angel investment. And that kind of kickstarted this experience of just really enjoying what startups were about. It was so good to be able to work so intimately with other people who were also extremely passionate about the industry. And from there, in COVID, I actually then had to close that startup. So I've seen what a startup looks like also like growing. I've also had to close the startup. So that was a really interesting experience as well. And then now I had my few roles within technology companies who are probably like, let's say, high growth startups, because they are around like Series B, Series C area. So I generally work for startups in that kind of space. So it's interesting to see it from someone who started a startup who was in the angel investment side of things, but now also working for big startups that are around Series B and Series C. So I've seen both sides of everything. And then from there, I am also now starting my second venture in the e-commerce space. So I've got a bit of different experience everywhere. And in that case, in the e-commerce space, I'm so strict on bootstrapping. So it's interesting to see it from like someone who's raised money, someone who's worked for companies that consistently raise money, and then now someone who have all of that experience, over 5 years experience, have committed to a bootstrapping model and is quite rigorous and passionate about the bootstrapping model.
Yeah, that's really interesting. So the first initial thought is, why are you now set on bootstrapping? Was there something that happened when you raised that you were like, oh, this was not the right approach, or you did it too early, or what were you thinking around that?
Yeah, that's a good question. So I think for Azura, the company that I first started, definitely super early, not super early, because it's such a difficult experience, because when you are building technology, it is so expensive, and you're always caught in this challenge where you need the money so that you can actually get engineers to develop the product. But the clarity of the vision is so low. So you really have, and also the relationships that you're building at the time are like quite depending on what type of investor that you actually attract as well. And I think at the time I was probably not so aware of what type of investors are out there. And I think Ben mentioned it's like the values of an investor. I think at that time, I didn't fully understand what the values of an investor even really meant and how to partner with an investor. So I think that from that perspective, it's so important to understand who the investor is and why they're investing in the first place. So I think that that's like the one part that you have to consider when you are looking for external investment, whether it's angel or institutional. So I think with that case, I think it would probably be more on the side that I didn't fully understand what that relationship of an investor and a founder looks like. And I think that that's something that I see even at the Series B and Series C, and working closely with, the company, because at that time, although it's quite large, you still definitely have exposure to the CEO and as well as their kind of funding experiences. And that is something that I consistently see is like the wrong investors or the wrong partnerships, regardless if it's angel or at the Series B and Series C level.
Yeah, that's awesome that you've had that experience and exposure to founders at that level. What would you say, from talking to them and your own experience, what would you say would be a push to, okay, no, I really need to raise now, versus actually it's fine to just bootstrap a bit, see how we go, get more clarity around the vision, versus no, like I should really raise now?
I think a proven product in the market. Also a community-backed kind of approach when it comes to products in the market. So you're leveraging not just, the product that you have, but you also have a community that backs you and like quite a few customers that back you as well. And they've already adopted the platform. And I think that investment should be utilized ultimately for growth that you've already established bootstrapped. So that's what I would say that is the key component, because it should fast forward your growth. It shouldn't actually be the reason why you're growing.
Awesome. Thanks so much, Sharine. I'm going to invite back now Emily and Ben, and we're going to do, I'll basically just go around, give your, I guess, if we can do top tips to the audience before we open for questions. So I'm going to pin you guys to the screen. And if you have it top of mind, please feel free to shoot. Just sort of, rapid fire top tip that you have.
Top tip for deciding between bootstrapping and capital raising?
Yeah, or anything to do with capital raising, bootstrapping, fundraising that you think the audience could really benefit from. Even better if it's a lesson that you learned yourself from experience that you know not to do, or something or to do. So I'm trying to also pin Ben to the screen. Oh, I can only I'll unpin myself. Sorry. There we go.
Okay, I'll go. I guess, obviously having been a lawyer, there's like a very specific set of problems that I generally was exposed to from my past experiences that repeatedly kept happening. I think it's like making sure that things are documented and stored and kept properly. I mean, obviously this isn't a plug necessarily for Tallystone, but I created this product from seeing that this is a genuine problem for startups, which is that even if you decide, okay, I'm bootstrapping now and I'm going to capital raise in the future, so you go, you just don't think about documentation and about making sure that your governance as a company is all secure, because your focus is on growth, and as it should be. Like the majority of your focus absolutely should be on the business, but understand that at some point in the future, if capital raising or an acquisition or something is in the future, then you can't just completely ignore this stuff. You can't ignore the fact that there are responsibilities that you have as a director, that there's a regulator out there who is watching you. Make sure that like the bare basics of those responsibilities are taken care of, because the last thing you want is you get to a certain stage and go, actually, you know what? I do want to raise capital, and I now have years and years of his company history that I have to now get ready and in a format that works for an investor. So I think just try and like break it down into little chunks of work rather than trying to turn it into this big thing, because time kills deals. And if you're trying to capital raise and you realize like, oh my God, I've got 4 years of company information that I now have to tidy up, it becomes really difficult.
That's a really good one, Emily. Thanks for sharing. Ben, top tip. Ben, you got one?
I've got, look, something, and because we're really at the early stages of capital raising or just getting investment in general from grants or otherwise, we're recognizing really quickly that we have to be so detailed with the documentation to, I guess, of our processes to know exactly where we should put the money that we hope to gain. So, for example, for us, we essentially treat every stitch in every product as $2 to $3, depending on the complexity of the stitch, and we time it down to the second so that we know exactly where the limitations are, so that we know if it's justified in buying a specific machine or tool, or let's say a laser cutter, specific elements, so we know exactly where it's going to save us money and why and how. And then also the other consideration for us is our materials and process. Some materials can't be laser cut, some can. It's a detailed example, but for us it's about those detailed documentation of process. And so we use Notion, for example, and Excel spreadsheets to keep everything to the second, more or less, so we know if and when we receive hopefully a grant from Xero in the coming months, how to split that perfectly. And if we were to go into a capital raise round, I guess you'd call it, we can show where we used it last time or where we would, and give all the details. And I think that's probably my best bit of advice and where we've had to catch up over the last few weeks and months.
Yeah, awesome. Thanks, Ben. Sharine, your top tip.
Yeah, so I definitely believe what Ben just mentioned. Be very clear what you're looking to, what you're the reason why you're trying to raise capital and what you would invest in. So that's definitely my biggest learning in my experience. And the second part is also understand what your business model is. I think that a lot of people forget what type of business model they're in. And I think now, because there are different types of companies that investors are looking for to invest, it was only recently, I would say in the last 10 years, that even e-commerce businesses were looked at as lucrative investment deals. So before, it was very much with e-commerce, even in itself, you buy and sell products really ultimately. And because of that, most people didn't really look at it as a lucrative investment. But now you've got Gymshark, that's become $1 billion business in e-commerce. So I think that when you are looking at raising capital, be very clear about your business model and what you can do bootstrapped, and what type of business model is very difficult to bootstrap, and just looking at the reality of that and raising capital on what you think is important to you from a values perspective as well. If you would like to have relationships with your investors, or if you don't believe that that's something that you want to influence your type of business as well.
Yeah, awesome. So that element of control is really important, and values. Yeah. Thanks for the top tips, guys. It's Q&A time now. We've got a bit of time. Feel free to send in any questions you have. We already have a couple, so we'll start with those. We've got one here from, I would just scroll past it. Crystal had a really good one. If we could get, I guess all three of you to answer this one. What are some key indicators that you used to determine when to switch from, okay, I'm going to bootstrap, to now I should actually look at investors? A little bit similar to what we talked before, but talking about how that decision has impacted the growth of your business and the strategy of your business. That question can be taken in a few different directions, so I'm going to leave it up to the panelists on where they want to take it, but who wants to start with that one?
Okay, I'll start. Once again, obviously that point hasn't arisen for us yet. So, but it was actually, I had a thought bubble after I'd had my slot, which is, you asked, when is the time that you would, with an idea, think about capital raising? And I think, very obviously, anything that's deep tech, anything that's complex hardware, I think those are really obvious points where it's literally not possible for the product to come into existence without capital. And so though there are certain moments where you can't have a business without capital. So yes, it makes sense that you go raise. And I think that's the point at which any business, if you go, okay, I can't build a product without it, then you go but you've figured out how you're going to build it, then you raise capital. Same thing with like a growth strategy. Is like, I know how I'm going to do the growth, but I need the money to do the thing. Then that's the point at which you raise.
Yeah,
That's
really
really interesting.
Yeah.
You go,
No, go Ben. Were you going to add something or?
No, I was gonna yap. You say your bit. I'll join in.
Okay. No, I was just going to say that's a really good point. I think what some people might struggle with too is when they're looking at deep tech or even complex hardware where you cannot build that yourself, even if you are an amazing engineer, even just to get the units that you need, you will need to raise money. Would you advise how much time, because time is a really important resource with businesses, and anyone can answer this really, or Emily, you can just hop on this one, but how much time do you think they should spend, for example, applying for grants, which are, equity-free funding? You don't really give away, well, most of the grants that I know, you don't really give away shares in your business. It's rather just milestones that you need to meet, and the grants are usually, offered by companies that are trying to achieve something in particular. How much time would you say to spend, say I'm an engineer, divvying up between applying for grants versus looking for like-minded investors that specialize in funding, those certain types of products? You might have seen it, Emily, in your experience with companies, but either three of you can answer that one.
I feel like then you're going through this experience, so you might have more to add. The only thing that I would add to, like you said about the business grants, is like government grants, there are some available that specifically target deep tech hardware that aren't available to B2B software. So those, and we're talking about like up millions of dollars available. And I think it's like match funding and things like that. So industry growth program is an example. But otherwise, I'll leave the rest of this question to Ben.
I'll do my best. I think in many ways it probably is above my pay grade to answer, but to go back to the indicators to determine whether we're going to shift from bootstrapping now to capital raising, for us it was about our time. We can't expand the business, we can't grow the business if we are on the sewing machines making the product constantly. And on the same note, the other indicator for us was the machinery. So I talked about laser cutting before, and we are not able to build a laser cutter as much as I'd love to, and we need that to speed up our major manufacturing efficiencies, cutting processes. So for us, the indicator was our time to make sure that I could be out or Frank could be out, just gaining contracts or discussing, wholesaling with local stores, things like that. It was really about our time and about manufacturing speeds. And so we're looking essentially to raise for technology and also to bring someone in as a part-time or full-time sewist to cover one of us so that we can grow slowly but surely.
Thanks, Ben. And I'm just looking at a few of amazing questions, by the way, Crystal. I'm looking at some of the questions, and Sharine, I think you'd be really helpful in answering this particular one about managing investor relations. How do you think your experience with dealing with investors, not just in your own venture that you did, but also witnessing founders and companies that you're working for manage their investors, what would you say are important tips to remember when managing that relationship with investors? And how and what would be common pitfalls or mistakes that first-time startup founders could make in those relationships with investors?
It's a very good question. I think any type of relationship requires connection, and it's always an investor themselves. Yes, they are obviously, it's like a business relationship, and there is some sort of not disconnect, but it's not as connected as, let's say, like your family or like your intimate relationships. But I think one of the biggest pitfalls I see founders, and myself even included, is the lack of transparency, and not just because you don't want it, but because you forget about it. And that is very common because investors, especially silent investors or investors who are not involved in your business. There's sometimes when you're so invested in building the business, especially when you are raising capital or you already have capital, the stakes are so high because you do have the money already invested in the business. And so you're so laser focused on building a business that you sometimes forget to either continuously build this relationship that you have with investors, which it, like anything, requires time, and it requires that emotional connection. And at the second part as well is that you forget to give those constant updates or getting them involved in your townhouse meetings or town hall meetings. And you forget to invite them to maybe come join and meet your team or come into the office. And that's still part of the connection of an investor. They still need to believe that you have a vision. And I think a lot of founders, because they're so laser focused, and that happened to me, as well as like time poor, you forget to maintain and build that relationship intimately.
Yeah, that's really helpful, Sharine. Thank you. Another question here. Crystal is just sending these banger questions. And again, other audience members, feel free to send in questions. Otherwise, Crystal's at the helm here. But have any of you had any experiences where you wished you timed? And I guess this is more so for, actually, it is definitely more so for Sharine, given Ben and Emily are still technically bootstrapped at this stage. But did you have any times where you wish you timed your fundraise a bit differently for your startup?
Absolutely. I think that when you're timing your investment strategy, you really got to consider economic situations. And sometimes you can't really foresee that. So that becomes a challenge. And you as a founder are so laser focused in your business that you forget that, yes, your business is maybe extremely high growth, the financials look good, but it doesn't matter if your business looks good if you're going into an economic crisis. Because at the end of the day, your startup lives in a realistic world where there are different types of budgetary constraints, and it doesn't matter really what you can deliver to that. And also in terms of the value of your product, is your product of value at this current stage in the market? And even though you may be adopting at a high rate, like for example, you're getting a lot of customers, you're making some form of revenue, is that product actually in demand right now, considering the current economic situation of the world, or is it just a nice to have at this point in time?
It's a really good answer, Sharine. Thank you. This one is kind of for all of you because you all have co-founders, but how would you say you approach deciding how to fund your business with your co-founders? How do you manage it, for example, if one co-founder is insistent on one funding model and another isn't? Have you had times like that in your startup? And if so, how did you manage that?
I'll talk quickly because I think Emily and Sharine will have more to say here. But I think we recognized early in our business that I was going to be design director or the driver from the design perspective, and Frank would take lead in the business. So in many ways, we set the decision making for separate parts of the business, and so he has the ultimate decision in terms of funding and a lot of the business side of things, and I get final say in terms of the design. And that's worked really well for us, setting that up early to avoid challenging decisions like that.
That's actually a really good strategy. And for most of you on the call, up to 30% of startups can fail just because of co-founder relationships. So any tips on co-founders, I encourage you soak that up because it is a beast on its own. But thanks, Ben. That's an amazing strategy you guys use. What about you, Emily and Sharine?
For my end, I have been a sole founder and I've raised capital as a sole founder, and now I'm bootstrapping with a co-founder. I think that Ben is completely, that his approach is exactly the same approach we had as well. It is so important to define roles and responsibilities and what departments and what decision-making requirements are fall under each person. In my case, I have a creative director, so he makes all of the decisions when it comes to marketing, creative branding, design, all of that. And then I work within like that founder kind of CEO typical role. So funding, expansion, growth, all that stuff. So yeah, as long as you do that, of course, any relationship always is going to come through, like it's always going to be complicated, but I think that also allowing that friendship to grow as a co-founder is important, and to be able to open up in conversations at work about your own intimate relationships or even your own intimate life, that's super important, and making sure that that person is mentally healthy to continue the venture. because that's sometimes a lot of founders just focus on the business side of things, but they don't actually cultivate the relationship side of things. And a co-founder is still a relationship.
Another awesome tip, Sharine. Thank you. How about you, Emily?
Yeah, we were so unconscious of this, and we were starting, especially considering the statistic that you shared, Alicia. What we did was, before we even decided we were going into business together, was to like go and answer these kind of hard questions that we've been talking about today. So, you know, like, what is our exit strategy? How long do we want to stay involved? What are our values? What level of control? What's our financial goals with this? All of that. And, you know, what's our investment journey going to be like as well? So we actually had a Google document that we were kind of all working on, and we had like a list of questions, and we'd all contribute, and we'd work through each topic every time that we met up. And it was only when we were 100% sure that we were aligned on this, and that, you know, that we could, you know, there's got to be leeway. Like, you know, we make a decision at one point in a year, we'll have new information, so decisions can change, but we realized that we did have alignment, at least on the approach and the way that we think about these things. And so that was part of us deciding, like, okay, this is the kind of person that I want to go into business with. So yeah, it's so important being aligned on the journey, and but also then being aligned on giving each other the leeway if circumstances change. Like if a personal circumstance were to happen next year for one of us, you know, understanding that we will be able to have the leeway to work to a solution rather than it kind of devolving into a fight.
Yeah, awesome. Thanks, Emily. Well, look, guys, we will end it here in saying that for those in the audience, if you want to connect or follow along with their journeys, just quick round robin, guys. If you go through and tell them where they can find you or just your website. I think Franco's added some links in the comments, but if you want, for example, us to, we'd love to connect with you on your business on Instagram or anything like that. Round robin, share that. And then in terms of REAPRA itself, we would love for you to follow us on LinkedIn. We have a podcast coming up and a monthly newsletter full of really fun venture building tips to follow. But yeah, we'll round robin with the panelists and we'll end there. We'll start with Sharine.
Hi, everyone. So follow me on Sharine Duran on LinkedIn. So just basically type my name in, or Sharine Duran in terms of the LinkedIn kind of URL. And if you want to follow me on Instagram, the business that I'm starting now is called Official Rest Day. So it's very much on the rest and recovery. So if you if you're athletic or if you go to the gym, we're building basically products that are very focused on recovery. And yeah, follow us on the journey. We basically talk about how you can improve your sleep and improve your rest and recovery, right?
Awesome. Emily?
Cool. You can find me on LinkedIn as well. We're a B2B SaaS, so that's where we play. My URL is it's Emily Price. Otherwise, you can also find Tallystone at tallystone.com. Yeah, follow us on LinkedIn, sign up for our waitlist, be a part of the journey. It'd be great.
Amazing. And Ben, lucky last.
Yeah, you can find me on LinkedIn basically in the same way, Ben Wood on LinkedIn. And then Whipwork is best to be found on Instagram. So at Whipwork, WIPWRK. And then obviously Franco posted wasteinprogress.com.au. That's us.
Amazing. Well, we'll leave it there, guys. Thanks so much. Thank you so much to the panelists as well for making the time. Sharine, we'll let you get back to your day in Morocco. And everyone else, have a lovely evening in Australia. Thanks again, guys.
Thanks, everyone.
Take it easy.
Everyone.
Thank you. Bye.